There's been a lot of talk about an AI bubble and an overall stock market bubble. And I've been of the opinion that while there are some stocks that are overvalued, the market overall, I don't think is in a bubble. I'm finding undervalued stocks every day. And in fact, in this video, I'm going to present to you two undervalued AI stocks you can buy right now. Current market prices compared to the fair value calculations, I see these companies being undervalued. So let me share these companies with you and talk a little more about the state of the stock market.
I want to thank the Motley Fool for sponsoring this video. Visit fool.com/Parkev for the 10 best stocks to buy now.
So the first undervalued AI stock I'm presenting in this video is Salesforce. The customer relationship management company is using artificial intelligence internally to provide customer service at lower cost, making each employee more productive. It's also launching artificial intelligence services for its clients to utilize in their businesses. Salesforce stock is currently trading at a market price of $260 per share, but I calculated its price to be worth $339. And my discounted cash flow valuation that you're looking at here is a proprietary valuation model that I created, and I'm forecasting the company's free cash flow increases from $12 billion in 2025 up to $33 billion by 2035. So less than triple its free cash flow over the next decade. Salesforce management team provided an optimistic forecast between now and 2030, where they expect their revenues from now until then to grow by roughly 50%. The company's growing revenue double digits, and the customer relationship management industry is increasing at a faster rate. So Salesforce is not quite growing at the rate of market increases, and that's what has investors concerned about Salesforce. Other companies are delivering more innovative services utilizing artificial intelligence, and that's caused a deceleration in Salesforce's revenue growth. Still, despite those factors, when I discount the company's present value of all the free cash flow I expect it will generate between now and the very long run, it comes to $206 billion. I used a weighted average cost of capital of 10.45%. I used the capital asset pricing model to get the cost of equity of 11.24%. The company has a beta of 1.19, and I used a risk-free rate of 4.1% and a market risk premium of 6%. Salesforce has relatively little debt with just over $11 billion compared to its $247 billion market capitalization, so its balance sheet is relatively strong. The business overall is, I would say, slightly above average risk, given the industry it operates and the tenure it's been inside the industry. It's got a strong leadership team with a little bit too aggressive when it comes to acquisitions. I think they've been paying a little too much for the acquisitions. They haven't realized the synergies from those acquisitions. So for my taste, they're a little too aggressive when making acquisitions. But other than that, I don't have any major complaints with the management team and how they've led this company over the years. The next undervalued AI stock I'm going to present is Amazon. Amazon's trading at a current market price of $219, and I calculated a fair value for the stock at $295. Of course, Amazon stock is under pressure here in 2025. It is directly exposed to the negative impacts of tariffs, and that's why you're seeing Amazon stock trading at such a low valuation. Additionally, investors are concerned about the outages caused by Amazon this week, but that really hasn't had a negative impact on the company's stock price. In fact, on the day of the outage, Amazon stock price was up. A lot of investors asked me, why was that the case? Was it not bad news for the company about the outages? The answer is yes, it was bad news that the company had those outages, but on the same day, you had positive developments on the trade front, and the trade barriers, the increase in tariffs, are more important right now for Amazon stock than the outages were on the day of that announcement. President Trump had given some easy ways for China to lower that 100% tariff that President Donald Trump is threatening against imports from China starting November 1st. So those developments, that good news offset the bad news from the outages, and therefore Amazon stock price increased on the day despite those outages. But Don't get that mixed up. The outages were still bad news. It's just there was offsetting good news that made it where the stock price increased. The present value of all of the free cash flow I expect Amazon will generate is over $2.1 trillion. The company is a cash flow generation machine. I'm forecasting its free cash flow will rise from $50 billion in 2025 to $342 billion by 2035. Driving this growth will be increased efficiencies in its e-commerce segment, increased percentages of advertising as a percentage of overall revenue, which comes at much higher margins than its business overall, and then increasing growth rates from its Amazon Web Services segment faster than the overall business. And of course, Amazon Web Services generates higher margins, higher cash flow than the rest of the business. So those powerful tailwinds, along with the fact that I expect people will spend more money online. Right now, as a percentage of overall spending in the United States, it's still roughly around 20%. I expect that percentage will continue increasing. I don't expect 100% of shopping to happen online, but certainly a larger percentage than it's happening right now. It's just so much more advantageous to shop online than shopping in person, and Amazon will continue to increase the convenience with which people can shop online. Faster delivery, more items, more convenience will attract more buyers to its platform. So the weighted average cost of capital I use to discount all of these cash flows is 11.18%. Now, the reason we need to discount future cash flows is because money in the future is worth less to us today, right? All of us should agree that we'd rather have a dollar in our pocket today than a dollar in our pocket 5 years from now. That dollar in our pocket today, we can invest for 5 years and earn some kind of return on investment, which would make it more than what we can get with just $1 5 years from now. So that's why you got to use a discount rate. I'm using a discount rate of 11.18%. The capital asset pricing model, the cost of equity is 11.8%. The beta for Amazon is 1.28. So Amazon intrinsic value per share, fair value $295, current market price $219. So Amazon stock looks undervalued to me. So here you have, in this video, I presented two undervalued stocks. These stocks are not in a bubble, to be sure, but overall, there are stocks in the market that are very expensive, that are approaching significantly overvalued territory. And some of those stocks have very large market capitalizations. So because of their position in the indices, like the S&P 500, like the NASDAQ and others, it makes the overall market look expensive because they represent a large percentage of those indices. A stock like Tesla, which I've repeatedly stated is significantly overvalued. When you include Tesla in the several indices that it participates inside, it makes those indices look overvalued because Tesla is approaching a $1 trillion market capitalization. Palantir is another one trading at a nearly $300 billion market capitalization. Another stock is trading at a forward price to earnings of over 200. Tesla's at a forward price to earnings of over 200. So those larger market capitalization companies trading at these super expensive valuations makes the overall market look overvalued. That's why I haven't been investing in indexes very much this year. I've been more picking stocks. Amazon is one that I added to my portfolio recently, along with a few others like Lululemon, Pinterest, The Trade Desk, and I bought Uber and Nvidia stock earlier this year. I actually own a put option on Tesla stock because I think it's so expensive. So there are very expensive stocks in the market, and if you're not careful, you can have some of those in your portfolio through an index, or maybe you bought them because you thought that they were worth the super expensive price. And in some cases they are. In other cases, like Tesla, I don't think they are. So overall, I don't think the market is in a bubble, but I do think, and I am finding several companies that are trading at super expensive valuations that I don't think they deserve to be trading at such expensive valuations. Hey everyone, I'm excited to announce that my book is finally available for sale. I've been working on it for more than a year now, so I'm really excited to finally share this with you now. It goes through my framework for evaluating stocks. Some of you often ask why I like this stock or why I like the other stock, and this framework provides you the things that I look at when I'm evaluating stocks. I've added the link in the description below.